You are listening to the Innovating Cannabis podcast, where you will meet entrepreneurs, cultivators, scientists, doctors, and inventors in the cannabis industry.
I'm your host, Pam Schmiel. In addition to producing and hosting this podcast, I'm a freelance writer and editor for the Cannabis Industry Journal. You can find links to my work and contact information in the show notes. Today, our guest is Darren Gleeman. He's the managing partner of MBO Ventures, an investment firm that works exclusively with employee stock ownership plans, also known as ESOPs. He believes ESOPs could be the golden ticket for cannabis companies looking to boost profit margins, especially as debt comes due and financial pressures mount. While the process can be complex, the benefits are substantial. The government actively supports ESOPs and even subsidizes them by eliminating state and federal tax obligations for companies that participate. Darren breaks it down for us in this episode. Let's welcome Darren Gleeman.
Who you are, and tell us a little about MBO Ventures, and then want to really get into the whole employee stock ownership plan. Break that down for us.
So my name is Darren Gleeman. My company is MBO Ventures. We are the nation's largest ESOP investment bank. Myself and my partners, we've structured over 400 ESOPs in the past 26 years, over 27 billion in enterprise value. We've structured over 7 billion in ESOP debt. Back in 2022, I uncovered the cannabis ESOP structure, which allows cannabis companies to do an ESOP. And when I say uncovered, as we know, cannabis firms are destroyed because their cash flow is hurt because of taxes. And their income taxes are greater than anybody else's income taxes in the United States. And that's because of this thing called 280E. One of the benefits of an ESOP, right? Let me just go back to what is an ESOP. ESOP is just another way to sell your company. That's it. You can sell your company to a private equity firm. You can sell your company to a strategic buyer, or you can sell your firm to the employees via this ESOP structure. And it's not something where the employees need to get involved at the beginning. The owners are the ones that initiate this whole thing. So the question is, why would you sell to your employees? They don't have any money. How do they actually do it? All right. Why? Well, the government wants you to do it also. They really want to democratize equity ownership, because there's no way most employees can go out and start their own company. They don't know how to start their own company. That's not what they do. But if you want to own your own house, you want to send your kids to college, you then want to be able to retire in a place, how are you going to do it as a line worker? It's almost impossible. And so what we found in the United States is how people make money is by getting equity, owning things. So the government wants these employees to become owners. So how do I convince you as a business owner to not sell to private equity versus selling to your employees? They have no money. So they gave huge amounts of subsidies, huge amounts of incentives. And when you put it all together and the owners know about this, which they don't, it's a no-brainer to sell to your employees via this structure. It's a no-brainer. The biggest problem is that people hear about ESOPs and they say, oh, it's an employee stock ownership plan. It's some kind of 401k. Oh, I already have a 401k. What is it? And then people start talking about it. Accountants start talking about it as if they know. Oh, I've heard that this is this thing. Or attorneys, oh, I heard this. And they know nothing. So part of my biggest issue is always going out there and explaining to people, what this thing is. Why would you do it? But bottom line, it's just another way to sell your company. And when you do it, it really is much better than private equity. A strategic buyer means I'm a cannabis company and another larger cannabis company wants to buy me. In the normal world, if a strategic buyer can come in and pay you oodles of money, a lot more than anybody else can. So nobody can beat that as a sale price. Let's say your company is $5 million in net income and it should be worth, let's say $30 million. Okay. A strategic buyer can come in and say, I'll pay you $100 million because I want that space and I want it today, right? They have a lot more money. Nobody can beat that. That's a huge, ridiculous offer. But if a private equity firm says, I'll pay you 30 million, well, the ESOP can pay you 30 million also. And because of the huge tax benefits that you get, it's a complete no-brainer. You're making a lot more money to sell to the ESOP.
So how does that work as the employee? Like, what are we paying for? Like, what do we
Sure.
get? Yeah.
Yeah. Okay. So first, when private equity says, let's use that example, a $5 million company, that means a $5 million in profit. And let's use you do your public relations, right? So let's use a $5 million public relations firm, right? And let's say the value of it is 5 million times, let's say, multiple of 5, make it easy. 25, make it easy, it's 30 million. So $5 million in net income. The value is 5 million times 6, 30 million. It's called a multiple of 6. All right, $30 million. Well, the ESOP can pay 30 million to private equity. Okay, well, employees don't have money. Private equity, when they say they're going to buy you for 30 million, they're not giving you 30 million in cash. What they're doing, they're leveraging everything. So what they'll do is from their own pocket, they're going to give you $5 million. You're the owner. You get $5 million from them. Then they're going to borrow off of your company's cash flow. So if your company is making $5 million a year, what we do is you go to a bank or a lender and they borrow 5 million times, let's say 3. So they borrow 15 million. I, as a private equity firm, am not taking that risk. Your firm is taking that risk. So they borrow the 15 million and that goes to the owner. So 5 from the private equity firm, 15 from the bank, right? So that's 20 million. The last 10 million, they say this. In our negotiations, you told me you were going to grow by 8% a year and do all these things. Fantastic. As long as you reach those milestones that you just told me about, it was in the contract, you told me that, then you get the last $10 million. If you don't reach those milestones, you're not going to get the whole $10 million. That's plain vanilla private equity. Okay, everyone thinks, oh, they're going to give me $30 million. No, that's not how it works. So with an ESOP, it's identical, except there is no initial equity. There's no one to give you $5 million, right? So with an ESOP, they go out to the same lenders that private equity does. We got the same lenders, and we borrow the same $15 million, right? Instead of having the third party lever you up, the company levers themselves up. They borrow the same 15 million, and that 15 million, their rate's going to be much better, actually. So they borrow 15 million, the company borrows it, and then that 15 million goes to the owner. So the owner takes out 15 million, and the other 15 million is called a seller note. A seller note is an IOU from the company back to the owner. That's how it doesn't cost the employees a penny. That's how they get that $30 million. Now, here's some of the benefits, right? That $15 million seller note, right? That's a loan. And we also got it in the example, right? We had a $15 million note we got from, let's say, JP Morgan for the first 15 million. Just like a mortgage, JP Morgan wants the first right on your company, right? They have that like the mortgage, right? So the second piece, the seller note, that's not like a mortgage. They're the second lender, right? They're called junior on that lending stack. So if the company goes under, the public relations firms goes under, JP Morgan takes it, and that seller note guy has nothing. So by definition, that seller note is more risky and should get a higher interest rate. You deserve it, right? It's your company. You should get a higher interest rate for that. So let's just say the interest rate for that is for you, for this, for that seller note is, let's say 15%. That's a nice interest rate. But it's hard for that company to pay 15%. It's stressful for the company. It's harsh. So all right, listen, Pam, instead of taking 15% for your seller note for your company, you're going to take 5%. Well, the company is much easier for the company, but that's not fair to you. You deserve 15. I just told you deserve 15. Well, instead of that 10% difference, 15 minus 5, instead of that 10% difference that you're owed because you deserve it, you're going to get these things called warrants, which is like a stock option, which will allow you to buy back a chunk of your company in the future. And you can get warrants to buy back anywhere from 10% of the company to 40% of the company, right? And so let's say you want to get back 20% of the company. And you can choose it by doing something called rollover equity, a phantom rollover equity. You want to get back 20% of the company. Okay. So we sold the company for $30 million. To get back 20%, well, there's a price for you to pay to buy back 20% of your company. right? If you have to pay $100 million to buy back 20% of your company, that's ridiculous. That's meaningless. But to buy back 20% of your company for the ESOP structure, and it's a $30 million company, it'll be about $1 million. Okay. So that means at any time, and the time frame is about 15 years, 15 to 17 years. Any time in the next 15 to 17 years, whenever you want, you hand in those warrants, you write the check for $1 million and get back 20% of your company, which is a huge second bite of the apple for you as that owner, right? That's a big deal, right? So now, again, comparing private equity to that, this is better. This seems much better. Now, you sell the company for $30 million to private equity. You live in New York City. You have to pay capital gains on that. Capital gains tax in New York City would be about $10 million for $30 million sale. $10 million in $10 million. That's what it is, right? If you're in California, most across the country, it's same thing, right? $10 million. If you sell to the ESOP, the government says, oh, you sold to ESOP. Here's another benefit. We're going to allow you to defer those capital gains. And if you structure it correctly, you can defer it forever. So you can defer the capital gains. That's a nice big little advantage to be able to defer the capital gains tax, right? That's number one. Number two, if you sell the company to the ESOP and you become 100% owned, you don't have to. You can sell 30%. Let's say you sell 100% of the company. And you have those warrants, right? You sell 100% of the company. The company now has additional magic. A company, this public relations firm that now is owned by 100% by the ESOP, pays 0 federal income tax forever and 0 state income tax forever. Forever.
Even what? That's right. That's right. And now you see, there's all these huge advantages which seem too good to be true, and nobody knows about it because they think an ESOP is some type of 401k. And private equity, they kind of know. So private equity puts out a lot of these myths sometimes, and they just throw all these monkey wrenches in because they don't even want you to think about it. Because if you go head to head with private equity, ESOP wins out all the time. Unbelievable. So how does that, where was the complication in the cannabis industry, or was there any complication, because it's not federally legal and
Yeah, so in cannabis industry, everyone's like, well, it's not federally legal. Can you do it? How does it work? It's impossible because 280E is you're not allowed to take any deductions. How do you do it? And it's just in the structure. We're not doing anything. We're not getting around 280E. We're not evading 280E. We're keeping 280E completely intact, no deductions. But let me ask you this, so you'll get it. You know how Native American tribes pay no income tax?
Mhm.
Do they care about depreciation, amortization? Do they care about deductions? No, they don't care because they don't pay taxes. Who cares? It doesn't matter. When you pay no taxes, it doesn't matter about deductions. It just doesn't matter anymore.
Right. Because
You're
you're not
completely
right. You're
tax-free.
not deducting. Right.
Yeah. So what happens here when you're tax-free, the way it works, I don't want to get into the weeds with you. It might be for the
Yeah.
clients, for the audience might be too much, but bottom line, you pay no taxes, deductions just become irrelevant.
That's amazing. So, and then
Sorry, I know we're getting to the myths, but this is actually what the ESOP is. It's actually better than the myths, but people need to know what it is first anyway.
yeah, okay. So I just kind of want to make sure I really
Did I
understand.
blow you away?
Yeah. I want to make sure especially when people start throwing numbers out there, I'm like, wait, 10% of that, what,
Yeah.
that whole thing kind of throws me off a little, but as an employee, I see the benefit as a company.
Mhm.
And then, so I might have just gotten a little confused on who was who in the explanation. So
Yep.
as the employee, and I don't have the money, but you took out the loan from the company.
Not the employees. Okay. So the employees cost them nothing. This is just a humongous benefit for the employees. The company itself is the one that goes and borrows the money, not the employees.
Right. So how do they benefit like say they leave the company and they want to cash out? Like how do they how much of ownership or percentage of the company are they given?
Yeah, so the owners, you mean the employees?
The employees.
The employees at the end of the day, if we structure it where in this example, we had 20% warrants, at the end of the day, for free, the employees would have 80% of the company.
Oh, so the benefit is the company is giving their employees a
You're selling the company to the employees via this ESOP thing. So the ESOP is actually a trust. So the employees now become the owners through this trust. And that's it. So if you have 20% warrants, they will end up with 80% of the company. Now it's not a profit sharing plan where it's like a piggy bank for them. Really what's going on is over time, the employees are allocated shares. And it could be, let's say, over 25 years, where you're allocated, if it's 25 years, all the employees get 4% allocation a year. So it takes them a long time. So this way, if someone leaves in 7 years, okay, they have a certain amount of stock. If someone joins in 10 years, they're going to start building stock also. So it becomes this a very large pie for the employees. And if the company, let's say let's say this public relations firm that we're playing with right now does the ESOP today. Okay. And then let's say in 7 years, one of the largest public relations firms in the world comes in to buy it for $100 million. Okay, this is what happens. We terminate the ESOP. All of the employees vest, they get their stock. Okay. You remember in this example, you had warrants. You hand in the warrants, you write your check for $1 million, and you're going to get back 20% of the company. So if $100 million comes in, you now would get another $20 million because you're the warrant holder. And the employees get $80 million.
I'm the company. I'm the PR firm, you're saying.
I'm
And
saying if you're the PR firm and you, Pam, were the actual owner,
yeah.
you, Pam, hand in those warrants, hand in the $1 million, you, Pam, now get $20 million, and then all of your employees get $80 million. And when the $80 million gets split up, it goes into their retirement accounts, of which they don't pay tax on that.
Oh, so that's how it gets distributed if it liquidates or
That's right, or you sell it. Or, when you retire at 65 and you're worth, let's say, $50,000 for the employee, then the $50,000 goes into your retirement account when you retire.
So basically, the money that the company is funding the employees' way to pay for this is through the government
Subsidizing all those notes. They
subsidizing it.
subsidize everything. And there's other subsidies also they give. Yeah, exactly. The
Wow.
government, it's almost like a government-sponsored leverage buyout.
Yeah, that is just, I mean, that is amazing.
That's
I don't
amazing.
know why people wouldn't want to do that.
Because this is why. This is why.
Yeah.
Number
Okay.
one, they have no idea.
Yeah.
They have no idea. And number two, I just explained it to you. All right. And you know how phenomenal it is, right? You kind of get it. You kind of get it.
Mhm.
Next week, if we got back on the call, on the podcast and had another call, you're going to know it was great, but you don't know, you kind of didn't remember it. You don't really remember what it is. You just know it was really good. And then in a month from now, you're still going to know. But let's say you spoke to an attorney or an accountant that gives you these myths. And then you can be like, yeah, I don't really remember what it was. And by 6 months from now, you're going to completely forget. And that's really what it is. But people just don't know about it. And it is complicated. I was able to dilute it down for you. And I'm one of the very few people that can dilute it down. I had a podcast one time. And I was with these two attorneys and me. And I said at the very beginning, I'm like, an ESOP is just another way to sell your company. And then one of the attorneys was like a 78-year-old guy. He's like, I've been doing this for 45 years. I never heard that. That's not an ESOP. An ESOP is a defined contribution plan under subsection 407T. That's what it is. And then I said to him, and I love this, I'm like, is that what you think it is all this time? I said, no. Back in 1973, back in the day when you started this, they wanted to get employees to become owners. They wanted to figure out a way. How do we sell it? So the head of the Senate, Senator Long, needed to do this, and he didn't know how. But there was a bill coming in for the retirement plans called the ERISA Act. And so he shoved it in and figured out how to make it into this defined contribution plan. That's not what it is. That's what you thought it was all this time? No, that's just how they got it in. And it was just a great podcast because this guy, he forgot more than I know about the little technical intricacies, but he never really knew what it was. If this guy ever came on your podcast, first of all, people would fall asleep in about 7 minutes and you would have no idea what it is. You would have no idea what it is. because
Yeah.
he wouldn't explain to you like this. He would explain it to you in like such technical detail and nuance and code.
Oh,
It was,
yeah, you wouldn't even know.
and
So
that's why.
so basically it's just it's just forming your a company. You would structure it and then a lawyer would have to execute it, I guess. Is that
Yeah,
how?
so what happens is, yeah, with the investment bank, so we actually do the entire deal. So we're quarterbacking everything. So we're coming up, what's the value of the price? We discuss those warrants, we're discussing everything in a row. And because it's an M&A deal. This is it's a real M&A deal. And that's why it's kind of expensive, right? Because the client has us, the investment banker, they need an investment banker. Then you have their M&A attorneys, and those M&A attorneys, they also have ESOP attorneys, and the cannabis space is regulatory attorneys. And there are some firms that do all three, right? So that's attorneys. Then you have to hire this guy called a trustee who represents the employees, and that's how you come up with the fair market value of the company. And that trustee has to hire a valuation firm, and they also get their representation of a lawyer. It's expensive. It's a big transaction.
Yeah, that's a big transaction. So then that leads me to, what about smaller companies? The cannabis industry is really made up of mom and pop small companies. Mostly. I'm going to say,
Yeah.
would that work for any of
It
them?
doesn't, it's just too expensive. It's hard. And plus you have the costs. Let's say the annual fees for this is, let's say, $75,000 a year, which if you're making $2 million a year, that's nothing. But if you're making 300,000, no, the annual fees are just too expensive for that, right? And then
Wait,
the setup fees are too expensive. I would say the floor to do it on your own is about 2.5 million in net income. The fancy word that we call it is 2.5 million in EBITDA. That's the fancy word.
yeah, but a lot of dispensaries are making 3 million.
They can do it. That's
Yeah,
right. They can do it.
average, it all depends on the market and the
Yeah, that's
saturation,
right.
but that is kind of the
Well, I think it might be the average. I'm not sure where it might be the average in revenue versus the profit. I'm not sure what the average profit is. The average revenue, if the average net income was 3 million, then that means the average revenue is about 9 to 10 million. Maybe in New York City. Elsewhere, it's not. The smaller mom pops, if they have one store, they're not making that money in one store. But
yeah.
we do have a way, I've been working, we do have a way we are looking at, and we're doing this right now, is combining a lot of these smaller mom pops together into
Oh,
a larger organization, because these little mom pops, they can never sell. No one wants to buy it. What we're doing is combining them together into a very large, massive companies throughout the country. And then you have an ESOP holding company on top. And then underneath them, each one of these small boutique cannabis companies becomes an independent subsidiary, and they all get to benefit in the ESOP structure. So that's something that we're working on right now.
oh, that could really work.
Yeah,
That
that works.
that seems very complicated,
It's
but
complicated, but it works.
it's complicated, but it works,
Yeah,
and
yeah.
and there's benefits for everyone, and it increases your. So does it increase your profit margin? Like, I know the article was saying, trying to you can increase your profit margin, even though you have 280E. So,
Well, what happens here, because of 280E, what's going on is it's your cash flow is crushed. So let's say a company, let's use your example. Let's say it's $10 million in revenue, and let's say it's $3 million is their net income before tax, right? They're paying in taxes probably about $2 million. So it's 3 million minus two, they come back with $1 million in cash. If they are structured inside this ESOP structure, they make 3 million, their tax is zero, so the cash flow is 3 million. So in this example, they have 3 times as much cash flow than if they were just a regular company. Now they can go out and do a lot more things with that money than they could have done before they had the money.
oh, right, and I'm sorry, and then you also, right, you had said, right, they'll be exempt from any
No
income tax,
taxes,
no
no
tax.
income.
So that's
See, you already forgot. You see, people forget.
yeah.
Yeah,
No,
yeah,
it's just a lot to take in.
yeah. It's a lot. It's a lot of information. But
It's
the key takeaway here is, when your company is owned by the ESOP, you pay no income taxes, and
yeah.
the owner they're able to defer their capital gains tax, which are 2 huge things. That's
Those are,
that's the 2 takeaways. And you get 3 takeaways, and you get the warrants to buy back a chunk of the company in the future. Those are the 3 takeaways that you want to remember.
yeah, yeah, that's great. And that's a great way to end, except I do have actually one more question. I'm not sure if you answered it, is it appealing to, if in the end you really wanted to sell your company, is it
Mhm.
appealing to the buyer, or is it a deterrent to the buyer if you have an ESOP plan
No, not at all. So
structure?
you already have the ESOP. Remember, in ESOP, you sold it. So now it's owned by the ESOP. Same company, same everything. Now the sole shareholder is the employee stock ownership plan. So the plan owns the company, but it's the same exact company. Didn't change. The board of directors
So
is
they
pretty
get the
much
same benefits.
everything is the same now. When a company wants to buy you, no, because they have these employees that are working harder, and there's statistics that show retention is 300% greater,
Oh,
productivity is like 2-3% greater per. I mean, it's
I love it.
phenomenal. So when the company comes to buy it, these are usually stronger companies. And no, there's no issue. If I'm going to buy a company owned by an ESOP, I'm going to buy a company owned by Joe, Dave, and Miriam. There's no difference at all. No
Okay.
difference.
Okay, cool. Wow, that was really thank you for coming on. I think that was really great information that the market needs to hear.
Yeah.
And especially because everybody's just drowning in this cash flow and debt and things like that. And also look at these huge MSOs who, the big conversation is the debt's going to be due soon.
Uh-huh.
Like all that debt, I
Yep.
thought it was like this year, next year, it's like all going to be crashing in, and how are they going to survive that? Like one company, I think Verano is in that crush right now.
Right. So
Uh,
the only way they can survive that debt cliff, one of the only ways, because they have so much cash flow, is if they become an ESOP. Now, these public companies can't become an ESOP because they're public, right? How do they do that?
oh,
So what they would have to do is they have to sell themselves to an ESOP. Well, you can't do it. They're in Canada. These companies are all public on the Canadian Stock Exchange. So you can't just sell it. They don't have the cash. No, there's no cash to do it. But they could do what's called a carve out. So what they can do is they stay the public company and they can carve out a chunk of their dispensary in the United States and sell it to a NewCo being owned 100% by an ESOP. And once they do that, now the warrants I was talking about before sits in the balance sheet of the public company. I know it's confusing. They sit in the balance sheet of the public
I love
company.
it.
Yeah. And the company now itself, all those dispensaries now run completely tax-free, which means that company is now running with twice as much cash as they had the day before. Now, if they're running at $100 million in net income, before they were paying 50 million in tax, now they're paying zero. So now all of a sudden that debt cliff becomes very easy for them to finance.
I don't know why they're not doing it.
Maybe they are.
Oh yeah, maybe they are. Maybe that's
Yeah,
maybe that's what they're trying to figure out. This is
that's
big.
right.
This is big stuff.
It is big stuff. And I'm under NDA for a lot of these clients, so I couldn't talk about it.
Okay, yeah, of course. Yeah, right. Okay. Wow. Okay.
But yes, every public company is looking at this. Every public company is looking at this, and I get the calls from them all the time.
And are you one of the, uh, I mean, specialized, are companies that specialize in ESOPs, or is this
That's
something
all we do.
that's all you do?
Oh, that's all we do are employee ESOPs forever. We've been doing this since 2000. So we've been doing it now for 26 years.
Oh
All we
my,
do is ESOPs.
oh wow. Wow, this is great news.
Yeah, we are
Okay.
literally the nation's largest ESOP investment bank.
Oh my gosh, that is, boy, the industry needs to know. I'm going to have to push that article around. Well, I'm glad that we did the interview and explained it much further, because I think it really even explains it much further. So
Yeah.
I really appreciate it. Thank you, Darren. That was super great news.